Okay, so we still need to go through the last chapter, chapter 12, in order to fill out our capital budgeting process. And so far we've talked about, well, how do you come up with the discount rate to use to discount future net cash flows to be generated by the project. And then we went through in chapter 11, the methods of evaluation, the payback period, discounted payback period, net present value, and internal rate of return. But we really haven't talked any about, well, how do we estimate cash flows? How do we do this? And so in thinking about this one, we need to. There are a few caveats that we ought to keep in mind first. And so let me kind of talk about some of those caveats. First, you should never include sunk cost. You should never include sunk cost. Because and what a sunk cost is this is a cost, something that you've had an outlay, and it really doesn't matter whether you choose the project to do the project or not do the project. You're not going to get that money back, and so it's sunk. Let's say that you had renovated a particular portion of the plant. And then sometime later, maybe 6 months later, somebody says, well, we're not using that space. We could put a project in. Well, you would not include the cost of renovation in the evaluating the capital proposal. You're not going to get that money back anyway. I mean, you've already done it. And so that's a sunk cost. And so you never include that in your in what you're doing. The next thing you want to do is you'll always include opportunity cost. And so opportunity cost ought to be included. That is, let's say that you own an apartment building and you have 25 units in the building, and you rent each of these units out at $1,000 a month. But you decide to live personally in the 25th unit. You decide to live there. Well, what's it costing you to live there? Well, it's costing you $1,000 a month, because that's what you could have rented it out for if you didn't live there. So that's your opportunity cost. So you do include that in your calculation. So that's another important caveat in this kind of estimation process that you want to think about. And then another important point in this is you always want to think incrementally. That is, you always want to think about the project. What is this going to do incrementally for us? So, I mean, such things as, in the book we'll talk about this, to the extent that a project siphons off sales from something else that we're doing, then it's no new sales to us. So, if it's cannibalizing another part of what we're doing. For example, let's say Coca-Cola is thinking about coming out with a new brand of product, and so they're going to introduce it. Well, to the extent that it gets some of their present customers to switch from drinking whatever their Coca-Cola products they're drinking now to drinking this, that's no new revenues to the company, and so you wouldn't want to count that, because you really just want new business, the new dollars, the net dollars coming in. So that's going to be important in this process. Okay, so that's kind of a starting point for us. So we want to be systematic. So when you think about this process, you want to think about it, and you're going to read some problems, and so you want to take the information that's given to you in the problems and kind of categorize where it belongs. And so there are three main areas of categorization. There's the initial outlay. That's, whatever expenses that we had to pay to get this thing going. That's part of my initial outlay. And then I want to estimate my operating cash flows. The operating net cash flows, inflows from doing this thing. And then finally, I want to consider any salvage value for doing the project. Okay, so as you're reading through these the problems in this chapter, you want to try to identify which category the information should go into. And remember now, some of the information could be some information that's a sunk cost, and you leave it out. It's just extraneous information, so you wouldn't put that in at all. But you just have to read the problem. Okay. All right. So let's kind of begin this, and I'll start out. We'll just look at the initial outlay. What's going to go in there? Well, certainly if I'm buying anything, the purchase price of whatever I'm buying would go in there. So the price of new equipment, whatever it might be, that would certainly go in there. Okay? So I would definitely want to include that in the initial outlay. Well, am I going to be able to sell, if I'm talking about a replacement project, will I be able to sell any equipment that I currently own? So the selling price of old equipment would go in there. Now, once again, think net. So, to give you an example, let's suppose I'm buying a new truck, and the truck is $40,000, and it's going to replace an old truck, and I can sell the old truck for $5,000. Then my net cash, so I got $5,000 coming in, $40,000 going out. Well, that nets out to $35,000 instead of $40,000. Does that, you see what I'm getting at? Now this is a problem though. If I sell a piece of old equipment, the question is, what am I carrying that on my books at? So if I fully depreciated that old truck and I sell it for $5,000, then I'm going to have to pay a capital gain tax on the selling price of that old truck. So I'll have to consider a capital gain tax or loss tax credit. In other words, a loss tax credit, let's suppose I'm carrying that whole truck on my books at $7,000 and I sell it for $5,000. Then I've got a capital loss of $2,000, and that gives me a capital loss tax credit. I'll get some tax money back for that. So that will go in there. Now, another thing that will go in here is with this equipment, is it costing me anything to ship it to my factory or wherever I'm operating from? Are there installation costs? So transportation and installation cost would also go into the initial outlay. And another thing, and this will come up in our operating expenses, if I have these costs, remember for capital expenditures, the government's going to require me to depreciate the assets. And so I'm going to have to consider that depreciation. And they're going to make me, I won't be able to write these costs off immediately. I'll have to add those into the purchase price of the new equipment. All right, so those are the main things. And there's one last one. You need to add in any change in net working capital. All right. Net working capital is just the difference between current assets and current liabilities. And so let's say that the project is going to require me to hold an inventory of spare parts or whatever for this new equipment. And I'm not going to be able to finance that through an increase in accounts payable. Okay? Well, I'm going to have to pay for that up front to build up that inventory. So I'll have to put the net working capital in at the beginning. Now I'll recoup it on the backside when we wrap up the project. But that's going to be my starting point. And so these are the things you're going to run into as you go through the problem set. All right, so let's move on. And now we're going to think about your operating cash flows. Okay, so you'll have these, let's say your years, we have a project, years 1 to all the way out to T number of years, or we'll say N number of years, and out here. All right, so that's how long the project's going to last. And I'm trying to get my estimation on cash flow for each year. Then, and I want to do it incrementally. So the cash flow in the teeth period, well, it could be period 1 or 2, whichever one it is, will be equal to the incremental change in revenue in that period less the incremental change in cash expenses in that period. Now, here's going to be the strange one that's coming in. Remember, depreciation's not a cash flow. It's not there's no cash moving. It's just a bookkeeping entry. However, it will affect a real cash flow, namely your tax liability. And so the government's requiring me to depreciate over time a capital expenditure. And I want to calculate the real cash flow, which is my tax liability, for each period. So what I'm going to have to do is I need to subtract out my change in depreciation for the year, multiply that times 1 minus my marginal tax rate, and then add back in the change in depreciation for the year. Because that change in depreciation, once again, the depreciation's not a, there's no cash moving, and I'm only wanting to consider it because I want to consider the tax implication. So, so you'll go through this process for each year, and you'll see in the book, I think it's in one of the appendices in the book, they give you the government's MACRS, and some they call it makers, and it's the depreciation rates for each year depending upon the categorization of the capital. So the capital could be 3 years of depreciation, 3-year class life, 5-year class life, I think, and then they have, I think it's 7 and so forth. You'll see it in the text in that as it's laid out. Now, when you look at that, the 3-year class life depreciation schedule will actually go over 4 years of the time, and the reason that's so is because the government assumes when you buy a capital project that you buy all capital is bought 6 months into a year. So so the first year I'm going to get a half year's depreciation, and then I'll get 2 full years of depreciation, and then another half year depreciation, and it's accelerated over time, but you'll see that one as you go through that. Now, you might want to think about the underlying variables here. So for revenue, you're really thinking about, well, the price of whatever it is you're selling times the quantity that you're selling, or the volume that you're selling. So P times Q. Well, that's not surprising. For expenses, cash expenses, you'll have any fixed cost, a certain amount of fixed cost every year. In other words, let's say the project has me leasing something. Well, that's going to be a fixed cost I'm going to incur every year, and it won't change no matter how much I sell. But you'll also have variable cost, and of course, variable cost will depend upon how much I'm producing and selling. And then the depreciation, of course, your marginal tax rate goes in there. Now, for all corporations today, at the federal level, that tax rate's flat. It's 21%. If you're in a state that has an income tax, that's usually, for many states, that's fixed at 5%. So for, like in the state of Alabama, it's 5%. So it'd be 26% your marginal tax rate. And so then you just go through this process for each of the years. That's how you would do it. All right. And then finally, we would need to calculate what the salvage value is. And so salvage value, at the end of the time, do we have anything that we can sell off, like the equipment that we bought? So selling price of equipment would go in there. Then we would also, once again, I'd have to consider capital gain tax or tax credit. So capital gains, losses, tax implication. And then I would recoup that net working capital, so I'd add back in net working capital. Now, this salvage value then would be added into the nth year, the ending year's operating cash flow to give you the cash flow for that final year, is how you go about and do this. So that's kind of the overview of this. And so go through and try to work out some problems at this point, and then we'll get back together. And if you have some questions about a particular problem, I can probably work that out. Once again, I posted some stuff to work through on Moodle. We've got the assigned problems out of the text, and so try to work it out. And we'll use class time once again. Drop in during class time. I'll be around, and you can ask questions then, and then we'll make it work. Okay. All right.